So again, putting myself in the shoes of a client, and I have myself had to think of all these things that when I was thinking of using the same tools that I'm talking about today in creating some sort of protection for myself and my family. First question is, how can I protect my family during my lifetime?
And that's, I think it's a really important conversation. I think definitely protection is the conversation which is often forgotten about. So it's good that we're all here talking about it today, because protection, really, this type of insurance is there to protect you and your family, and really to give you the financial security that you need up until retirement. So initially what we're talking about is family protection. And what that's saying is, okay, what are my commitments? Where are my risks? And really that's looking at the family as a unit. Do I have a mortgage? Do I have debt? Do I have children? Because all of those things put a financial strain onto the family. And if you're unable to work due to sickness, if you or your partner were to die, if you have long-term sickness, these things are all high risk for us until retirement. So I think we, a lot of the time, we think about what we're going to do in the future, what we're going to do for retirement. But this is really thinking about what happens if something happens in our lives that we're not expecting before retirement. What happens if, I get sick? What happens if I can't work? What happens if I lose my partner? And this is really, and that is why protection is so important, because it's really looking at the risk within the family financially and how you can insure that. So broadly speaking, this is split into different sections. So life insurance is the first part when we talk about insuring risk, and that is linked in this instance to a mortgage. But can be linked to children as well, and we'll touch on that. But property insurance is available for anybody that has a property with a mortgage on it, and you're looking to protect your family against the risk of death or critical illness. So you can have two types of insurance linked to your mortgage cover. But how we write that is we write it based on the mortgage amount, the mortgage term, and then that policy is set up on, if you're a couple and it's a joint mortgage, a joint life basis. If it's in a single name, then a single life. And it's there to cover the debt. And it's written into a special trust, which means that it's not subject to any sort of inheritance tax. So the life insurance is there to protect the mortgage. And that could be it could be your residential mortgage, or it could be a buy-to-let mortgage. So no differentiator there, but it is put in place to make sure that should the worst happen, your loved ones know that that mortgage will be paid off. So that's
something about it. I was going to say, if you're making a gift, because I think that's one of the interesting things.
Definitely, that's further down on this one. Yeah, so you've got the life insurance, then you've got education insurance, which Bimpe's mentioned there. That's about school fees. So lots of you will be paying school fees in the UK. And it's a commitment. The more children you have, the more expensive it is, as you obviously pay more school fees. And the question there is, what happens if one of you were to die, and how do you cover the school fees? Now, this type of insurance, this is really quite popular, because it's a great way of being able to cover your children's education. What you're saying here is, if something happens to either of us, we want to make sure that there's insurance in place, that the children can stay in that school, and that the school fees are covered. And it's a very inexpensive way of buying insurance. One is critical illness cover. So when we look at life insurance or critical illness, life insurance is always the thing that people think they need the most. Critical illness is actually the thing that we do need the most. Because when you look at the difference between, someone dying before the age of 65 or someone having a critical illness, there is much more likelihood of us getting sick. So critical illness is an important consideration as part of your overall protection planning. Then you've got private medical insurance. So that's covering you to be able to access private hospitals in the UK. Particularly important at the moment because of the horrendous waiting lists we're seeing in some areas of the NHS. And then the final one, which Bimpe just touched on, is looking at covering a gift. So in the UK, if you're giving a gift to your children, say, for example, you're giving a property to your children, which is what we use this for a lot, within those 7 years, if you were to die, there would be an inheritance tax risk. So what this insurance does is it covers that risk for the 7 years from when you make that gift, those 7 years that you'd be subject to inheritance tax in the UK. And it's a way of passing on your gift to your children and knowing that they will not have to suffer inheritance tax on that gift. Yeah, so this is just a touch on protecting your families with the critical illness cover. Now, we think, about the likelihood of critical illness, and this is a really stark, I think, slide to say that, when we look at the statistics in the UK, 1 in 4 women are affected with a critical illness and 1 in 4 men before the age of 65. Now, the most important thing that this type of insurance is covering is cancer, heart attack and stroke, because that's where a lot of the claims come from. But the claims can be for other things. So, for example, there's coma in there as one of the definitions for critical illness. And we've seen now with the spread of the pandemic and the coronavirus, that obviously that's been one of the issues. Now, that would be covered under a critical illness plan for the definition of coma, and so much more actually is covered underneath these critical illness covers. So it really is fit for purpose. Now, I just wanted to give you a figure, because I think the thing with insurance is we always ask ourselves, yeah, but will it pay out? Is it going to give me what I need when I need it? And just to give you a statistic here, in 2020 alone, this is just one of the insurance companies in the UK, Aviva, they paid out 314 million in critical illness claims, and have seen an increase due to the impact of COVID-19. And this is a really interesting one, actually. And although it's not specifically linked to the critical illness, it has been across the board. We've seen a huge influx of claims due to the coronavirus, to COVID, in life insurance, critical illness, and also to people that had protected their income and are now suffering from the long COVID that everybody's talking about. So there is an opportunity here to be covered against more modern illnesses, as well as, pre-existing illnesses that most of us have heard of for a long time. So it's to let you know that that is included, because I had lots of calls when COVID happened to say, does my insurance include coronavirus? So this is just covering off the school fees. So what I wanted to do was just show you an example of how they would be covered. So if you have a child in a fee-paying school at the moment, you'll be paying fees each year. Could be, from what to what really in London, to be honest. So I've used 40,000 a year for an example. And this is saying, okay, this is a couple. We've got our children in a fee-paying school in London. How much is that going to cost me? 40,000 a year. Okay, well, I want to make sure for the next 13 years, we're covered in case one of us dies. And so this insurance would pay you on this plan example, £40,000 a year, every year for 13 years when you take it out. So this is dealing with a child that was 5 going in, for example, and you want to cover yourself from when your child is 5 to when your child is 18 and they've finished their private school experience. So this insurance would then run alongside that at a premium of £39, just over £39 a month. And that policy, if you or your partner were to die, would pay the remaining person £40,000 a year for those 13 years to cover the school fees. Also written into trust. So a trust is like a will for your life insurance, which we do as part of the advice package. And what that means is that insurance would be written into a trust, which means that it doesn't pay into your estate. So instead of paying into your estate, your life insurance pays into this trust, which is like a tax wrapper. And then it can be accessed that way without any inheritance tax and going directly to the people you want it to go to. So an important extra, I guess.
Thanks, Naomi. Before we continue to the next section, just picking up on a question I've been asked in terms of how to access, because obviously some of our listeners in the audience are international people, and I say international, yes, they're of Nigerian citizens, possibly.
Yes.
Their main business is in Nigeria, but with a footprint here. What's the attitude of the insurance market to customers like that, in terms of ensuring that there is?
Yeah, so as long as you've got what we look at is the overall picture with the insurance companies. So if you've got a footprint over here and you're sharing your time between the UK and Nigeria, then that would be fine. You have to have some interest in the UK in order for me to be able to offer you insurance. So if you've got a property, if you've got a company, you know, you've got some commitments in the UK, then we can look to insure you in that way. And then we would work through with the insurance companies. So there's a number of companies that we can use, and we would guide you through that. It does depend. So you may find that not all of the insurances we would talk about, if you are here less often, you would be able to access, but we would advise you on a case-by-case basis. So.
Great. I just wanted to scroll back to there's a slide, which the one dealing with critical illness protection. And I know when you give the sort of the numbers, so when you say 250,000 for 45 to 65, someone's asking me, you know, what does that mean? You know, what that's that particular bullet point and the number.
Is this the 250,000? Did you say?
Mm-hmm. Yeah, exactly.
Perfect. Yeah. This is an example quote. So what it gives you is an example of how much that cover would cost. So if you were taking that £250,000 as a 45-year-old, if you were taking that cover, then that's how much it would cost you. So £145.20 a month. Premiums are in the UK, we use what's called fixed and guaranteed premiums. So the benefit of that is that you know that the premiums can't change. The insurance company can't change your premiums in the UK. We deal mainly in fixed guaranteed premiums. And the benefit for clients is you don't have to worry in 5 years they're going to review your premium and you don't know what that premium is going to cost, which is a lot of the trouble with reviewable cover, is that you have no control over what you're going to pay later. You're hoping it's not going to get expensive, but no, you know, it ultimately will do. With the insurance that we talk about here, it's priced as a fixed and guaranteed policy, which means that for the term of the plan, you would only pay that.
Great, thank you. So if we'll just